Hey everybody. Getting started here. One of my first lives that I'm going to be doing, this is an idea came up with of doing kind of a lender live, asking any questions, answering any questions, coming up with some topics that people often want to know about. These are kind of my frequently asked questions that I get a lot when people are trying to qualify to buy a home. And looking for any comments or suggestions as you guys have them. I'm going to check a couple of things. Feel free to drop any comments. I can see those comments as they come through, so go ahead and ask away. Okay, so I'm going to start with some topics. Like I said, these are things that people often ask, and kind of just wanted to get some conversation going. And again, as people join, or if you're seeing this, feel free to drop any comments in the box below, and I'd love to answer those live. If it is after the replay, I'll try to do my best to go back and answer those later. Understanding credit scores and reports. So I thought it'd be good to actually include a little bit some resources that I use when I'm talking to people think I've been muted this whole time. That's okay. MyFICO.com is the website I was talking about. How do you calculate your credit scores? How are credit scores created? What types of different FICO versions are out there? And MyFICO.com is geared towards those who, it's not owned by a credit card company. It's purely there for education purposes. And that's what I like most about it. So here I am. This is on the education tab. And as you can see, we've got a lot of stuff here. And might be potentially a little bit overwhelming. Let me see if I can get that on here. I'm new to this, so give me a second. Oh, lost the whole page. I guess I quit Safari altogether. Nope. Ah. I wish I had somebody who, oh, there we go, Safari. All right. Now I just got to figure out how to get the shape right. Yeah, that's close enough. So how scores are calculated. This is a visual that I like to show people. I always talk about the largest percent of how your credit is calculated, and that's going to be the 30% of how much you owe on each of your accounts, and then 35%, which is your payment history. So 65% of your credit is made up on those two categories. If you can have a really strong hold and control those two very well, you're going to have a consistently good credit score. What isn't going to be major factors, but are obviously still important, any new credit. New credit is going to affect your score of this variable of 10%. Length of credit history is about 15%, and then the mix of credit. Mix means you've got revolving debt, you've got installment loans, you've got student loans, mortgage debts, things like that. The mix of credit is important, but obviously not as important as these two factors, which is, again, payment history and amounts owed, 65%. So I always talk to people about make sure that you have your balances below 20% of their limit. 10% is most ideal. And then keep that payment history accurate and keep it on time. That is a huge one. If you had a late payment, a month ago, that is going to significantly affect your score. I've seen clients who their scores goes from 740, 760 down to 650 just by missing one payment. And then over time, it's going to lessen. So if a year goes by for that late payment, it's going to have less of an effect. But those are, again, the two biggest things. So credit education, what's in your report. There's so much good stuff on here. So again, write this website down, visit this. It doesn't cost you anything unless you want to get your own scores and go through and get the price, get access to the full thing. But at least just understanding what's available to you. So. Let me see. Love if there's any questions. See, I got a thumbs up. Thank you for that. Any questions that you might have? I'm going to go ahead and move on to a different topic. How to improve your credit score. Again, I just kind of talked about that. That's going to be. Let me get this. Here you go. I'm new to this. So that's going to be. Again, not having any late payments, having a good mix of credit, and you do have to establish it. So let's say you don't have a credit score at all. Okay, you're new, maybe you're just out of college, or maybe you just turned 18, and you need to start establishing some good credit. And so one of the things I tell people is it will take a little bit of time, 3 to 6 months for you to get a score, but you don't need too much to get started. You need 1 or maybe 2 revolving credit cards. Might be hard to get those if you don't have a score. So one of the things that we often talk about is called a secured credit card. And that is something where you're going to put money down. Okay, so think of it like you're putting a deposit. Let's say you can put down $250 or $500. That is a deposit that you're giving the bank. And then as part of that service with a secured credit card is you can borrow against that. And then they will start reporting that to the bureaus, and that becomes a credit card that you have. Okay, so if you do put, let's say, $500 down as that deposit, you don't want to borrow more than 20% of that. Okay, so that'd be $100. Do not let that card start creeping up. I know it's your own money, but the whole point of it is to build your credit, not to push your credit down and to have poor credit. So keep that balance below $100, and even $50 would be more ideal. Okay, 10%. So one of those, maybe two. Okay, another way to build your credit when you're new is getting added as an authorized user, somebody who has you as a friend or a family member. You can have them add you as an authorized user, and then that will start, all that history will get added to your credit. It will take, again, a couple months for that to happen, but that is something that you can do and will help build your credit fairly quickly. Okay, and then as time goes on, again, payment history, balances, the mix of credit, all those things will start to play in. And as you have a longer period of credit history, little things here and there, if your balances increase to 30% or 40%, it's not going to have as much of a negative effect as if you were brand new to credit. That will have a much bigger one. Okay. The impact of credit on loan approvals. It's basically where we start. Okay, so we look at three things. We look at credit, income, and assets. I wish I had some visuals here. But credit, income, and assets. And credit is often the first one. There are loans that don't require credit, but the majority of traditional loans that have good interest rates are going to require credit. With mortgage loans, we can go down as low as 580. And then, anything above 740 or higher is not necessarily going to start making any difference in your interest rate. But every 20 points, it will. So if you're at 580, and let's say someone compared to as a 600, the person with a 600 is going to have a slightly better interest rate because they have a better credit score. And then the same goes for someone who's at a 620 versus a 600. And that goes all the way, like I said, up to about 740, 760, depending on the type of product that you have. Also, getting approved for a mortgage is not just your score. It's also going to be the history. So we look at, and we call it your credit profile when we're putting together your application and your approval. So your score is one thing, but if your profile is very weak, or maybe you don't have a long history, you could have a great score but not a long history, and so you still may not get approved. So don't just think that, I've got a great credit score, so I'm good to go. There's a lot more that goes into that, which I can explain in later videos. Okay, so I talked about income. Let's touch on that here. So income is different types of income. I'll hit on that. A large portion of people are W-2 employees. What does that mean? It means you're a wage worker. Your taxes are being paid for by your employer, and it's actually deducted from your paycheck, right? So you've got your federal taxes, your state taxes, Social Security, things like that. You're a wage worker. When you are, full-time, 40 hours a week, that's the income that we can use, okay? And you have to have at least a 6-month history of employment, and we don't like when you have any gaps because that could mean that you are, unstable, but at least a 6-month history. And then we always go back and we ask you what you've done for the last 2 years. So whether that be you're in school, or maybe you did have, or maybe before you were a W-2 employee, you owned your own business. So we want to get some documentation and an explanation and history of that. But that's going to be the easiest, most simplest one to get approved for. However, there's tons of different types of income sources that are out there that people use all the time for loans. And the other one is going to be self-employed. There's a lot of negative things out there for self-employed. People say I can't get a loan if I'm self-employed, and that just simply is not true. Again, there's a lot of things that we do, and I'm actually very familiar and experienced when working with self-employed borrowers. You have different types of taxes that you can file. You're probably looking at that right now with your with your CPA or your accountant, and we can use those. You do have to have a 2-year history though of being self-employed. That is super important. Different than W-2, where we only require 6 months. But again, there's plenty of people who use their business to qualify, and we work with the CPA in some cases to figure out what does it look like, how do we make it make sense. Let me check some, see if we got any other questions on here. Nope, nothing yet. Let's see. Okay. So how to calculate your debt to income ratio. Let me see if I can find my iPad. Oh, let me get my iPad. Okay, I tried this out before the call. Let me see if this is going to work. iPad's kind of on its last legs here, so. It's probably a better way to do this, so if you know, please let me know. Okay, Brandon's iPad. Come on. There we go. All right. All right, let's start a new one. So we were talking about how to calculate your debt to income ratio. Okay, so, all right. It's not super difficult. Okay, so I'm gonna kind of keep with some simple numbers here just to help with the art of illustration. And we're gonna say, let's say you make $5,000 a month. Okay, $5,000 per month. All right, and you are W-2, so that is your gross. When you're W-2, we use your gross income. That is before your taxes are taken out. So if you're hourly, if you're salary, that's the number that we can go off of. Okay, and of that number, your mortgage plus all your other expenses cannot exceed more than 50% of that gross number. Okay, there's some loan programs that allow you to go higher, and there's some that require you to be lower, but 50% is usually the number. So if we took 50% of that, that would be $2,500. And we call that your back end DTI. Okay, so 2,500. So if that is the highest that you can go traditionally is 2,500, well, what if you have a car payment? Okay, so let's say you have a car payment of $500. Okay, and then you have a couple of credit cards, as we talked about, and we're going to take the minimum monthly payment on those. So if you have a credit card that has a minimum monthly payment of $50, we're going to subtract that out, and then that's going to leave us $1,950. I want to double check. $1,950 for your mortgage, okay? Because you're taking what your maximum number is, which is 50% of your gross income, and you're minusing any of your monthly expenses, okay? So $1,950 would be for your mortgage. Now, these are if we're putting on the very high end. We don't often recommend that you are at the top, but that is essentially what it is. So your debt to income ratio is going to be all your debts. So let's say we use these numbers and we reverse it. So let's say your mortgage payment is $1,950 per month. Okay, and then you have your auto payment of $500. And then you have a credit card of 50. Okay, so that's going to be a total of 2,500. And you divide that by what your gross income is. So in this case, our debt to income ratio would be 50%. Okay. So we can work either direction. We can say, hey, if you want your mortgage to be here, this is where your income needs to be. If your income is here, this is the max of where your mortgage can be. And we can kind of work those numbers in any particular way. Okay, so that's your debt to income ratio. Let's see. Let's talk about assets. I actually just had this come up on a file. Assets are important where you're getting the money to buy your home. You can't just pull money from underneath the mattress, or you can't be getting money from illegitimate sources and go and buy property with financing. That's going to create instability in the market if people are doing that with money that can't be sourced. It can't be identified where it came from, because then that money might be moving and might not be legitimate, right? And so when you're purchasing a home, an underwriter is going to want to see the last 2 months of your bank statements of where you're supplying your down payment and paying your closing costs from. Okay, so that might just be one account. A lot of people do have a lot of their funds in a checking and a savings with one bank. And so you're going to need to provide the last 2 months bank statements so that an underwriter can go through, and they will line by line, to see all of your deposits. Depending on how large your deposits are, they might have to be explained. Then they're also going to look at any regular occurring withdrawals. They're going to look at the names of those types of withdrawals, the amounts, and they're going to see if they can see from 1 month to the next if there's a regular withdrawal. And if that's not on your credit report, maybe it's an undisclosed liability, and that's going to also have to be explained. So 2 months bank statements. If you are also, wanting to, this is a really nice thing not a lot of people know. If you're wanting to purchase a home and you want to use your 401k, you can get a loan with that 401k up to whatever you're allowed. That can be used for your down payment, so you would liquidate it. And even though it's now going to be a new monthly payment, we don't count that towards your debts. So that's a nice benefit of using your own money, but with a loan to help you come up with it. So that's maybe money you've been putting away in your paychecks month after month. There's also a requirement in some cases for reserves. Let me make sure everything is muted here. There's a requirement for reserves. So each loan program is going to have different requirements. A lot of people who put 5% down who have good credit, there is no reserve requirements. What those are is essentially you have to have a certain number of months left over in your accounts, either the one account that you provided or if you have additional accounts, to make a payment if you, let's say you couldn't out of your normal source of income. And so in some cases you have to have 1 month, 2 months, 6 months, 12 months. And that's going to be dependent on the type of program that you're using, your credit profile, the amount you're putting down. That is something that we determine based on our systems that we have. If you own investment properties and you're purchasing more, you're always going to have 6 months reserves for any investment properties for the mortgage payments that you have on there. So if your monthly mortgage payment is $1,000 and you have 3 properties that have a $1,000 mortgage payment, you have to have $6,000 in reserves for each property. So it's going to be $18,000 left over after everything is complete with this transaction. With your down payment and your closing costs, you'll have to have an additional $18,000 left over for reserves. Okay, so I think for that's going to be all I'll cover for today. I just wanted to jump on and kind of do some frequently asked questions, see if I got any questions. I plan to do this maybe weekly, we'll see, just depending on how much traction it builds. These are things that I'm doing all the time, every single day. Like I said, looking over files, determining things. Just spoke with a borrower right now on things that the underwriter is going to want to see. They just went under contract, things that are on their bank statements that an underwriter is going to want explained, things about their income, some things that we can do to get creative with income and help with grossing up income with any sort of fixed sources. So again, thought it would be good just putting some knowledge out there. I would love for any feedback on this. So now that I'm going to be ending the live here in a minute, this will be available for replay. So please go ahead and drop some comments. I will still respond to those. And again, thank you for the time, and I'll maybe see you next week.